I'm Gus Farrow and welcome to Investing Channel TV. Previously, when we spoke, I covered gold expectations, and currently we're in the price range that we expected, which is great news. Today, let's look a little bit further out at future expectations. Currently, the yellow metal is trading around $1,700 to the ounce against an increasingly uncertain economic backdrop. The April jobs report was pretty horrific. The novel coronavirus has caused 20.5 million job losses, pushing the unemployment rate to almost 15%. However, this wasn't a systemic collapse in the US economy. So how much does that number really reflect reality? And what does it actually mean for the gold market? When you take the numbers at face value, they are much higher than during the financial crises of both the 80s and the subprime crisis, and also the highest since the Great Depression. The BLS have added to the gloom by suggesting that if furloughed workers were included into the data, it would be 5 percentage points higher. It's certainly true that a lot of furloughed staff are tomorrow's claimants in limbo. Personally, I suspect we'd see some netting out to the upside of people legally restricted from returning to work and ineligible for furlough re-entering the workforce. To be honest, we could twist and reimagine this data in 100 different ways, but the facts are that when an economy voluntarily shuts down, of course the data is going to be bad. Reopening the economy will be tough, as currently being seen in tensions across America, and perhaps most vocally and publicly vocalized by Elon Musk right now. Ending the lockdown will provide some respite to labour conditions, but at face value, a slow economic recovery should support gold prices. The main factors will be economic policy and higher inflation that follows stimulus hitting Main Street this time around. It's important also to remember that the USMCA replacing NAFTA is due to come online in July, and tensions with the CCP are turbocharging efforts to reshore manufacturing in the US. And this is also supported by President Trump having invoked the Defense Production Act, which gives him the unprecedented ability to direct the actions of manufacturers. Those factors all suggest a better than forecasted response in getting Americans back to work. And with all the focus on jobs, inflation could get majorly overlooked, which is bullish for inflation hedges like gold. Now, looking to the technicals, let's pull up a weekly chart first. And we can see the 50-week moving average has consistently held above the 200-week equivalent and is currently trending higher. Momentum continues to trend just below overbought territory, suggesting that there's potential for a leg higher. And in terms of price targets, we can see both $1,800 and $1,900 offering viable price targets in long-term highs. Flipping to a daily chart, we can see a pennant formation at current price levels, which is broadly seen as a continuation pattern. Both the long and short moving averages are trending higher, suggesting the potential of a future push higher. Now, as always, when we sit here and we have a chat through the charts and the markets, I implore you to do your own due diligence. Have an open mind when you're looking at these factors. It's a very, very fluid situation, and there are many known unknowns still to come on board. There might be a second wave, a third wave. We might be in the second wave right now. The main thing is just to stay diligent and always practice risk management. Thank you. Bye.